Hello everybody. Hope you're all having an amazing day. My name is Arjun and welcome back to the channel. Today we're talking about things that I wish I knew when I started my investing journey. So, I've been investing in the stock market for about 6 years now. I started shortly after my first job out of undergrad, and I've been investing ever since. I wouldn't say I'm a pro by any means, but there are some important lessons that I learned along the way, some of which I had to learn the hard and expensive way. So I thought I'd share some of those with you here today. Hopefully, by watching this video, you don't make the same mistakes I did and your investing journey can become even more rewarding. So let's start with the first one, which is that you don't need a lot of money to start investing. You can start even with small amounts. Let me take you down memory lane for a bit. So when I first started working, I was making around 25,000 rupees per month in Bangalore, which is one of the most expensive cities in India. And if I were to do a quick conversion, I think that's around $350 a month. So it was not a lot of money. And I remember thinking back then that investing is only something that rich people did, and I could never do so with such a low salary. It was only about a year or so later that my dad convinced me to start investing around 3000 rupees a month into an SIP, which again on conversion is around $40 per month, which is not a lot. But that really opened the doors for me because it made me realize that you don't need a lot of money to start investing, and that even, everyday regular people could invest even with small amounts. So if you're scared, nervous, unsure, just start with small amounts, like let's say $25, $50, $100 a month even, and you can slowly scale up as you become more comfortable. I made an entire video on investing for beginners, so if you're interested in that, you can check it out up here. Lesson number 2 is to not take advice from others. Everyone has something to say, but quite honestly, no one really knows exactly what's going on. Chad from your finance class is going to give you 100 different reasons to invest in that obscure cryptocurrency. But at the end of the day, it's your own money that you're investing, and you will sleep a lot more sounder, a lot better, if you know exactly what you're investing in. I remember in my early days of investing, I used to blindly trust Motley Fool's stock picks, even though I didn't fully understand the companies that they were recommending. One of their stock picks was GoPro, which is the company that produced action cameras, which got really famous about 4 or 5 years ago. I remember there being articles of, how this company is going to go to the moon, get in before everybody in the world owns a GoPro, etc., etc. And because of that, I invested in on the hype. But I think you can see where this story is going. But I ended up selling at a loss, I think around a 50% loss a year later because I didn't truly understand the company. For a more recent example, I've seen a lot of people invest in AMC and GameStop just because everybody else is, and they were feeling FOMO more than anything. But that's not the way you want to go about it. You want to have at least a decent understanding of what you're investing in before you put your money in. Be curious, read about things, form your own opinions, and invest in industries that you're familiar with. Sure, you can use other people's advice as additional information, but the final decision should be based on your research. You think that electric vehicles are going to take over the world? Sure, invest in them. You think that blockchain is the next revolutionary technology? Buy crypto. But don't do it just because someone else told you so. Lesson number 3 is that you will likely lose money at some point. In my opinion, the hardest part for any investor is seeing big red negative numbers all across their portfolio. But what I've learned is that this is just part and parcel of the stock market, and it's something that you just have to deal with. The market is a bit of a bumpy beast, And these fluctuations mean that you will have losses from time to time. This can be difficult for new and sometimes even more experienced investors to understand. But as long as you have a diversified portfolio and stick to your long-term investing strategy, you should come out ahead. So let's take, for example, back in March of 2020, the S&P 500 and the Dow saw declines of more than 30%. Those who didn't panic back then have seen their investments bounce back and pretty much reach all-time highs again this year. The stock market is a marathon and not a sprint. The key to winning is patience. So the lesson here is that we shouldn't be focusing on short-term losses, but instead focus on the big picture long-term. The fourth lesson is just to start simple, especially in your first year of investing. I've seen way too many people jump into the deep end of investing right from day one. They try to analyze some complex candlestick patterns to try and predict the next stock that will 50x in the next couple of months. Sure, sometimes you might get lucky and things end up working out. But when things don't end up going according to plan, that's when the situation becomes real bad real fast. If they end up losing a lot of money in that first year, they lose faith in the stock market completely. They pull out all of their money at a loss, think the entire stock market is a scam, and never end up investing again. So that's why I say in the first 6 months to a year, just try and keep things as simple as possible. Buy stocks of companies that are well established, that are not going anywhere, or just stick to index funds. Understand how the stock market works, go through some ups and downs in prices, and just get a general feel of things in that first year. Then, once you're a little more comfortable with everything, that's when you can start looking into some of the more risky investment options. The last lesson, number 5, is to keep emotions out of your decisions. People don't understand that 80% of good investing is just psychology and staying disciplined. If you let emotions take over, that's when poor decisions are made. Usually this involves buying when the prices are high and selling when the prices are low, which is the exact opposite of what you should be doing. The two main emotions involved are fear and greed. With fear, investors tend to panic sell at a loss when the market declines. Fear is the enemy of investing because it prevents you from taking advantage of flash sales that occur for good companies that have fallen in price. On the buying side, you have greed, which is when investors try and get rich as quickly as possible without really thinking things through. A good example of this would be the internet boom of the 1990s, where all anybody had to do was mention the term .com and investors would just jump in on the opportunity. Eventually, this all came crumbling down in the .com crash between 2000 and 2002. A good way to combat emotional investing is dollar cost averaging. Here, all you're doing is investing a fixed amount every single month, irrespective of how the market is doing. So you're completely taking emotions out of the equation. My experience in the stock market has been a hell of a ride. Lots of ups, lots of downs, nervousness, excitement. But if there's one thing I learned, it's that this journey has been extremely rewarding, and I hope it's something that I can continue along for as long as possible. For all of you watching, I hope that you took away at least a couple of things from my past experiences. Finally, if you did enjoy this video, do give it a like to help support the channel. Subscribe if you want more content like this, and turn on bell notifications to be notified of new videos. Thank you all so much for watching. I'll see you in the next one. Bye bye.